Welcome back, everyone. Today I'm going to be reacting to a video from the Nelson Nash Institute called Why Most People Get Infinite Banking Wrong. Hello, everyone. Welcome back to Perfect Spiral Capital. My name is Luke Tatum, and today we are going to be doing a reaction to Why Most People Get Infinite Banking Wrong. This is an official Nelson Nash Institute video that I haven't watched recently, but I really do like this one. I remember it resonating with me a lot. So this, in the video, you'll see we have David Stearns on the left, and we have Nelson Nash himself on the right, the creator or discoverer of the infinite banking concept. So let's see what they have to say, and I'll be pausing to make some commentary.
So David, take us back to when you had your first aha moment with the process of becoming your own banker, the infinite banking concept.
Okay, certainly. This might not be explained in IBC terminology. My first time when I got the message was we lived in Montgomery, Kim and I, and that we had 4 kids by then, and we were getting ready to move to Savannah, Georgia, and we decided to buy a house in Savannah, and we were getting a conventional loan, so I needed to put down 20%. And of course, I didn't have any money because I was in the Army, and all my disposable income was going to premiums. That was before my aha moment. We had to come up with some.
Just a quick note there. David is Nelson's son-in-law, and so part of joining the family is starting to do infinite banking. Signing up for some life insurance and taking a little dig at Nelson. I mean, it's pretty funny.
Some cash, and so we asked Nelson if how much cash renter value we had. We had enough for, I think it was a $20,000 down payment. He said, "Yeah, no problem. I'll get you a check in the mail immediately." And then, so I filled out the paperwork for the mortgage, and it was like, okay, what's your financials like that? How many assets you have? What's your net worth? And where did you get the $20,000 down payment for the house? And I was afraid to tell him where I got it because my thought was that if I was borrowing money for a down payment, then they disqualify me for a loan. Yeah. Okay, so I was like, how do I get around this and not tell them that this is a loan that I'm using for a down payment?
Right. So this is a classic misunderstanding. It's one of the reasons that infinite banking is such a misunderstood tool. Yeah, I mean, people like Dave Ramsey, all kinds of financial commentators will say, like, why would you want to borrow money from yourself? That doesn't even make sense. Why would you want to pay interest when you don't otherwise have to, et cetera, et cetera? Yeah, okay. I'm not going to break that entire argument down in this video. I've already done it elsewhere. But that is true. I mean, that's a situation. I mean, we are currently looking at trying to buy another property nearby, and I already know because I've already spoken to mortgage loan officers. I have friends who work in the mortgage industry, and I already know. I've already checked these boxes years ago to make sure that it's okay. And yes, so I was told you can list it as checking and savings. It's the same as having money in a checking and savings account to have cash value in your life insurance policy. Yes, you use a policy loan to access those funds in order to get your down payment or in order to, finance the property or whatever you're doing. But as far as the bank is concerned, it's cash. It's the safest money around. It's safer than money in the bank. So, yeah, it's fine. It's not a big deal. It's not like a loan, it's not like you're taking a home equity loan to make a down payment to get another property. It's just money that you just have. It's just considered it's considered to be part of your cash assets.
And so finally it came down to, well, it was a policy loan. I said, oh, that doesn't count. That's an asset you own, so that's fine. I went, really? So it was like it was a check the block, I mean, it wasn't like going down to the bank and getting a loan. I'm talking about. So it was like, wait a minute, this is different.
Welcome
Okay.
to the world.
And this mortgage company, they treated it as a different asset than a loan. And so that was 1992. And that was the first time I really started looking at it differently, thinking about it differently after that.
How that progression created a peaceful existence for you and your family.
Mm-hmm. I spent a lot of time talking to insurance advisors and to the general public and whatnot, because it's 90% of the people still don't understand what it's all about. They think it's about insurance. The more we look at it, the more we use it as a family. And Kim was on the computer yesterday with an insurance company, paying policy loans online, doing it herself. But the more I realize, all we're talking about is creating a cash flow management system where you don't lose control of that cash flow. And so if you don't have to worry about a third party interfering with that system, then it's perfect peace, because it's all up to you.
Yeah, it's all up to you, right? And so it can be misused. You can put a bunch of money into your life insurance policies and take it all back out in policy loans and never make a single payment on those policy loans and not have any plan to repay those policy loans. That's kind of irresponsible. If you're taking it all out to make an investment that you expect to give you a rate of return that you can use to pay off the policy loan, that's not irresponsible. But you can't get something for nothing. One of Nelson's rules, one of the things from becoming your own banker, is to play honest banker with yourself. Pay your policy loan back. Have a plan. Have a strategy. And so, yeah, it's asking more of you, but only from a certain point of view, because a bank is asking a whole lot from you. They ask you, when are you going to pay it back? How long do you want to pay it back over? What kind of monthly payment can you support? Again, I'm going through this process right now. I'm trying to demonstrate some of these things to a bank. And I know I don't have control of that. It's not my asset until I get the bank completely out of the picture. And so, the person who's getting paid is the banker, right? The bank is getting paid first. You don't get to pay yourself first. You don't have control over your financial system unless you're cutting out third-party financing. A policy loan, they don't care what it's for. They don't care when you pay it back. They know, the insurance company knows that they will be made whole. The loan will get paid off. Because if something happens to you, they'll say, okay, what's the death benefit? Okay, what's the outstanding policy loan balance? A minus B equals the remaining death benefit to go to the beneficiary named in the contract. It's as easy as can be. They don't have to repossess an asset. They don't have to auction it or foreclose it or any of those other things. It's as simple as could possibly be. And it's just a learning process. You have to take control of that, understand it, and manage your cash flows. It is a cash flow management tool which you have to use. It doesn't do it for you.
Then it's perfect peace, because it's all up to you, essentially. Okay, you don't have that interference from folks. And an example of that is that there's no methodology that you need to write down about, okay, how am I going to strategize and build a system, get to the point where I can have that peace of mind. Okay, it's like life. Things happen, so you have to understand that you buy policies as you can. You buy policies for reasons that you need to buy them for. Okay, if you have increased cash flow, then you can buy a policy. Okay, if you can afford it. Okay, if you have a new grandson or granddaughter, there's an opportunity to buy a new policy. Okay, somebody new to go through underwriting or whatever. To me, it's a lifestyle.
I do want to talk about that as well. And so the popular large marketing organization way of selling life insurance is to follow up with your clients every few months, every year, and review their stuff, review their policies. And what it really is designed to do is to give the agent more opportunities to sell more policies, to find some excuses to sell some policies. And this isn't just life insurance. This is financial services broadly speaking. So if you have a assets under management style person, if you have someone that's, managing your stock market investments, they're looking for ways, generally speaking, they're looking for ways to give you new products. Hey, have you thought about a Roth IRA? Hey, have you thought about an annuity? Hey, have you thought about this? They're just trying to add on things and earn more commissions, get more assets under their control, and have more money that they can manage to get more return for themselves on an annual basis. I completely disagree with that. I tell my clients and I tell my agents to tell their clients, that's not our way. The purpose of following up with people is to see how they're doing. They will tell you when they are ready. And that's how it should be. If they realize, hey, I've got some more money coming in, I got a promotion, we've got some more bandwidth, and I think we need to be devoting more of our income to premiums because the best place for your money to reside is in properly structured dividend paying whole life policies. It should be in an infinite banking environment if it's not deployed for something else. It should go there first and then get deployed for other purposes such as investing. Life insurance is not an investment. And so if they feel like, hey, I need more places to put money, then they should contact the agent. The client should contact the agent and say, hey, I need some more room to put money. The agent should not contact the client and say, hey, can you pay me more premiums? That's wrong. That's not the right way to do it. And so I tell my clients, you'll know and tell me when you need something. But I don't harass people for sales. It's just not, in my opinion, it's not the right way to do it.
Okay, it's not a financial plan. It's just a lifestyle. It's just part of living. Okay, just like everything else. I also shared that we've talked about that Kim and I bought Nelson and Mary's house back in 2010, and we tore it down and rebuilt it up. But that house was completely remodeled through policy loans, 100%. Okay, and the way we designed the policy loans was we designed them like construction loans, because every 2 weeks I get an invoice from the builder for about $20,000. They'd invoice me for for materials and labor, because it was a cost plus contract we did. So it was about a $20,000 invoice every 2 weeks. And so every 2 weeks, $20,000 policy loan. And it would take 2 or 3 days to cycle it and get in the bank account. But so we had that set up. And so it's just a cash flow, from the policies to me, to the construction company, and back around again. So it was all over with. We had that audit trail. And it's still, unfortunately, the house is still not paid for, but guess what? The deed is in my possession. Okay, I have a place for windfalls if I ever have an opportunity to get some, which will be. And we pay it as we can or want to. So that's perfect peace of mind.
So this last portion of the video is actually probably the most meaningful to me. Again, we're currently trying to obtain a mortgage to acquire a nearby property, and we don't quite have the cash value to do it, right? So I'm going to be getting a mortgage to do this really investment move. We'll probably rent out our existing home and live in the new home. But the idea is that you can set up the policy loans however you need to. You note that David says he designed the policy loans along certain lines. Now you don't choose from drop-down menus to pick how you want to design your policy loan, but conceptually, you model it to fit your needs. We did a very similar strategy to build the office that I'm recording this video in. In large part, this building was built using policy loans. It gives us peace of mind. The building is done. If you're doing a mortgage, you have the deed. You heard David say that. He had the deed. And so he already owns the house. The life insurance company can't repossess his house. He already owns it. That's pretty cool. It's just a question of wiping out the policy loans over time, or cycling from a mortgage into policy loans to cut your interest rate, which is probably what we're about to do. The point is that you make it your own. You decide, you design, you control how it works. And that is peace of mind. Hope you enjoyed this video. If you did, there will be another one coming up on screen in just a few seconds that you'll probably love as well, so please check that out. If you'd like to learn more about the various lies and half-truths in the financial world that keep you from living life to your fullest potential, that's what my book is for. It's called Between the Lies: How to Reclaim Your Future from the Banks and Wall Street. It's in print, digital, and audiobook formats, and you'll find a link to that below as well. Thanks so much for being here. I'll see you in the next video.